Hi everyone. Today I'm going to talk about an example of an exchange commodities exchange default. Someone posted on my video blog about the LME, the London Metals Exchange, and how it defaulted on nickel. And what it did was pay out cash, and it was practically a non-event. And so I'm thinking, well, if that happens to gold and the government, gold and silver, and the government of the United States do not borrow the gold and silver to pay out on the COMEX, what's going to happen is that the exchanges can potentially go to zero, the COMEX exchange, and the physical market will just go to the moon. I mean, one thing's for sure is that the 1 year contract is definitely going to go to zero because, I mean, who's going to want a promise to pay silver when it's clear that you never, silver or gold, when it's clear that you're never going to get it? Obviously, you're not going to want to buy that, right? And so, anyways, as you know, the banks are gonna, when this price drops, the banks are going to be laughing all the way to the bank, because people with gold and silver certificates, ETFs, pooled accounts, they get burned big time as the physical price skyrockets and the paper price drops to next to nothing. So again, I have to say once again, go get your gold, go get your silver right now, because if the default occurs and they pay out cash, no one's going to want to purchase um, a COMEX, a commodities exchange contract, because they have no reassurance that that's real silver and gold, because it defaulted, and again, uh, everybody got cash. So obviously that's not what a purchaser of those contracts are looking for. Also, keep in mind that silver and gold prices will be going down, um, even though that all the default and everything is occurring. The problem is that potential buyers are who are researching gold and silver are coming up with more and more people talking about a COMEX default, and they're not going to want to go out there and buy COMEX contracts. They're just going to go and buy the physical stuff and forget about the COMEX altogether. Now, of course, there could be some sort of catastrophic event that occurs between then and now, and gold and silver go to the moon, even on the COMEX, but that's low on the probability scale. An interesting news item is regarding Ron Paul's on questioning of Hilo Ben, and, and asking him um, if the central bankers are talking about backing the currencies with gold and silver, and it struck me as strange and unbelievable that Ben Bernanke that would lie to the congressman like that. I mean, it seems like a lie because there's no way they're not talking about it. And then you might say, well, I'm sure they lie all the time. Well, not really, because what they do is they when they are questioned, they don't answer the question correctly, and they answer it with what you assume to be a lie. So, for example, Ben was one time asked, "What about inflation concerns?" And he would answer, "Well, inflation is inflation expectations are well contained." Now, automatically from that statement, you assume that, well, wait a minute, inflation is really, really high. When I go to the grocery store, I buy stuff and it's more expensive than last year. Well, he didn't say that inflation was high, was low. All he said was that Most investors expect inflation to be low. And that is what they work on. They work on expectation of inflation. And if expectation is low, then they assume inflation is low because they're trying to keep prices down, right? Because whilst they print more money, right? Because inflation is the increase in money supply, which results in price increases. So their object is to always keep prices down, so that inflation, people's perception of inflation is lowered, and they help by lowering that perception by cheating the fudging the numbers. All right. Finally, I'd like to discuss a topic about deflationists out there. All the deflationists that are out there, and I've been reading a lot of their writings and so forth, and trying to understand where they're coming from, because I don't want to be blindsided about any kind of events. So I'm looking at different people's perspectives and looking at the deflationists and what they're saying. Basically, they're looking at the exact same data that I am, and they're coming up with different conclusions. They look at the what's it called, the short term treasuries, for example, and they see a flight to quality, but they also see that people do not for care or believe that inflation is going to be a problem, so they're willing to accept a zero return on their money. They see the higher interest rates on on, on non AAA debt as a deflation issue, as corporations are unable to fund new projects and unable to get more money, so that they will lower the price. So all these deflationists focus on price deflation, and yes, there's going to be price deflation for the short term, but the money supply is continued to grow, and none of these deflationists want to acknowledge that money supply growth always ends in inflation. They only see that people are tightening belts, and that is price deflation. And yeah, you know what? I have to agree. It is price deflation, but it's not monetary deflation. Money supply is increasing, and will result in increased prices down the line. This is what the banks want, because their assets are dropping off the raw off their down into the gutter, and they need to stop this price deflation so that they can sell their assets and get their balance sheets into the black again. And the only way to do that is to print. So we're going to see a lot of that. We're going to see Barack Obama do all kinds of new deals, and then the money supply will expand to unseen levels. It's already at unseen levels. The Federal Reserve has doubled their balance sheets in 6 months. In the last 2 months, they've printed $2.5 trillion. I mean, all this money, it takes a while to get into this system. It takes about approximately 18 months. Anyways, I don't have much time, so that's it for now. So until next time.